Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Saul Zenkevicius. Now, Saul is the managing partner and CEO of Brait Fund, which is a commercial investment group based in the Chicagoland area that focuses in both value-add industrial and retail investments throughout the Midwest. Saul has built a reputable career in the commercial real estate sector over the past 15 years. As a principal and owner, he has personally been involved in more than 200 transactions, and he really emphasizes his hands-on approach in the industry. And so over the past 5 years, Saul has established a commercial real estate portfolio valued in excess of $80 million and covering an impressive 1.2 million square feet. And so with that, guys, I'd like to welcome Saul to the show. My friend, how you doing? It's great seeing you again.
Great seeing you. Yeah, great having you here.
Yeah, no, excited to have you here, and it's been a while since we caught up. But as I'd mentioned to you, I've been kind of watching your different posts throughout the different social media feeds that you have going, and just you've got some exciting things working, and I know you've got your hands in a number of different pots. But excited to kind of dive deep into the industrial projects you have going on, the different retail projects, more specifically malls, right? And so you guys got some exciting things happening. In some various markets in the indoor mall sector. And so, but before we go down those various rabbit holes, Saul, maybe if you would, just for those that aren't familiar with you and your background, your story, maybe take a moment and tell us a little bit more about yourself.
All right, so I'll do a 2-minute commercial, maybe less. I'm originally from Lithuania. I came to US when I was 20, and I quickly dived in real estate. So I bought my first condo at Sheriff Auction in, I think, 2004, and I renovated myself and sold it for profit. I think it was $10,000 at the time, and I stayed in residential space. I was a broker. I had a brokerage. I sold that one, and I was fixing and flipping houses and multifamily apartments. Probably for close to 15 years, and I have hundreds of fix and flips under my belt. Eventually, I started doing more apartments, and I bought my first industrial property in 2017. In 2020, I sold all my residential holdings. So from that point, I started transitioning heavily in the industrial space, and mostly our buying was value add deals, half vacant, almost vacant. The first deal we bought it was completely vacant. At that time, 2017, they bought that facility for $9 a foot at that time. and right now it's trading at $70 a foot. And I just wrote a lease at $8 a foot in the same property.
So you said you bought for $9 a foot, and it's actually today like your retail value is $70 a foot.
$70 a foot. Yeah,
That's
exactly. Yeah.
insanity.
Well,
That,
yeah,
that that's way back before though. It's funny how big of a shift the industrial sector has seen. I mean, because 2017 is not that long ago, right? We're talking 6, 7 years
No,
ago.
no, but the notion was no at
Yeah,
that time. It was radioactive. No one is buying it. Stay
yeah,
away. It's like from offices. No one was funding it, so we had to buy it cash. Bridge lenders did not. I mean, hard money guys were afraid to fund this deal. I'm like, this $9 a foot. I mean, I can scrape this building and just sell it for land. So, but anyway, the how much it improved in terms of industrial, and right now it's just such a desired asset class, right?
yeah.
Uh,
Let's talk about that. And I don't mean to interrupt you there. I want to make sure that we hit some points before I probably forget
yeah.
about them if we keep going on. So, I first want to get a sense from you of the pivot. From residential. You at some point you kind of said, you know what, like I'm going all in. I'm selling all my residential holdings, and I'm gonna focus entirely on industrial. But yeah, obviously that first deal was a pivotal deal because you still today you're finding a lot of success in the industrial sector. But what really was the catalyst? What opened your eyes or got you interested or more importantly excited about an asset class 7 years ago when again it wasn't on the radar so much as to like the retail investors like us. Maybe some of the industrial guys, they're always a little bit more you have a little more forethought into like what the trends are and what's maybe coming down the pike. But it sounds like you absolutely stole this piece of property and have done quite well since it. So anyway, just back to the original question:
Yeah.
what was really the catalyst that pushed you into the industrial sector?
Now, 2017, I think it was a deal, but in at that time, it wasn't such a steal. It just that's how was industrial was perceived at that time if you're buying a vacant box, and it was neglected.
Yeah,
But what was the catalyst was, I had another friend who is my mentor. At probably 15 years ago, he went straight in industrial. He was in logistics. I went in residential. And then we kept in touch, and I just saw a progression of the portfolio size and the cash flow was just completely different in terms of how much output in time he has to do.
yeah,
And then, when we bought that first building, I stabilized it within 7 months. We refied it and took our cash out completely, 100% equity out within less than a year. And it was cash flowing after that about $200,000. And really, what we're doing with a one part-time manager, I put in that building four tenants, four industrial tenants, long-term leases. And I remember I did a presentation in CG. I compared what does it take to make $200,000 in cash flow annually after debt service on the residential portfolio and how on the one building, and it came down to just like, okay, it's 86 relationships and four relationships. I think it was close to 50 homes, 50 roofs,
yeah,
and it's like one roof. And there is no turnover. From a time perspective and effort in terms of just comparing the cash flow, when I stabilized,
absolutely.
I don't know if I was able to exit as a 5 million, let's say I would exit right now, but in terms of cash flow, it's just like, it doesn't make sense, in terms of how much effort I have to put out. So I started focusing more and more on industrial. I had an operation going. I was flipping houses in three markets: Chicago, Miami, and in Indianapolis, doing almost 150 picks and flips a year. So I wasn't able to shut it down completely. But yeah, it was just so clear to me that in terms of effort you put in, if you're able to look at 5 year horizon, right? Sometimes you have to stay without a tenant for 6 months, maybe a year. But if you can compartmentalize your risk, not in 12 months, but in 5 years, it's not really a risky asset. You just have to have more patience yourself. You have to have more patient equity and more patient debt. But in terms of cash flow and value creation, in terms of what output you have to put in terms of time and effort, it's not even comparison. Not at all.
Yeah, and the shocking thing about that, just speaking to CG, a brilliant group of folks, right? Like
Yeah.
there's some absolutely brilliant individuals in that organization. For those that don't know, it's Collective Genius. It's a paid for mastermind, kind of invite only. And you've got to be doing a certain amount. At least when I was in, you had to do a certain
Yeah.
amount of volume on an annual basis, and probably like 95%, at least when I was back in it, years back, probably 95% were 100% focused on residential investment, single family, but in a big scale.
Hmm.
Some that had thousands of rentals in their portfolio, some that flipped hundreds of homes on an annual basis, like you'd mentioned you were doing, but just big operations, lots of manpower, lots of moving
Yes.
parts, lots of holy shit, just lots of headaches, right? Like it takes a
Yeah.
lot to build a business of that scale, especially when you're flipping homes and dealing with construction crews in multiple different
Hmm.
markets, and just even the marketing engine on the front side to actually to build a deal flow in the pipeline,
Hmm.
right? To buy deal. I mean, there's so many pieces of that puzzle, and it always shocked me. When I joined that group, we were already buying parks, and I was kind of like a little bit of an oddball there. I was probably one, and it's I know it's changed over the years, but I was
Hmm.
definitely one of the oddballs. You probably were as well, just given your turn into to industrial. But I was always shocked at how and how long it took some folks to recognize the opportunity, and some maybe never did. Like they just kind of stuck in their own bubble of doing lots of deals, making a lot of money, but putting a lot of freaking effort into it. I
Yeah.
had endless count. I had endless conversations throughout my 2 years in CG of individuals that had made a lot of money, but they were burned out. They were absolutely burned out, and it's to be expected, I guess, if you're turning and burning hundreds of homes every year, or you buying portfolios one by one, or buying deals one by one and trying to build up those 50 homes that might give you that 150 200K of cash flow after debt
Yeah.
service. But anyway, just I was always shocked by how long it took some folks to kind of open their eyes, because they're brilliant people, but like there's definitely an easier way. There's an easier
Absolutely.
way to build wealth, wealth creation in commercial real estate. And maybe it's not industrial, maybe it's not mobile home parks, but
Yeah.
I feel like there's a number of others as well that are easier than that, of stacking one home at a
Hmm.
time to build up a big portfolio. So, and I did that as well. Many years back, I did the same thing. I kind of went the same path way back in my 20s, built up, a couple hundred single family homes. And so I understand it, but I also learned at some point, like there was just an easier way to skin that cat. So anyway, I went off on a
Yeah.
tangent there.
It's true, but I think it's just confirmation bias, especially you surrounding yourself with the folks who are successful. A lot of times you associate with the folks who are in the same industry, and somehow you're validating for too long. No, this is the only way to do it. We
Yeah.
know the best, and this is just anomaly what other guys are doing. But I don't want to digress, but for example, in my stage right now, we were buying old school up until now, where we tried to raise our equity ourselves, so with a few wealthy individuals where we don't raise money through broader networks, and because 80-20 funds or 70-30 funds, you just be creating a job. But finally, I think I met few individuals who kind of showed me different perspective. When you're having a fund, when you yeah, making a decent return for LPs, but not necessarily having a job for yourself, but creating also a fund where you almost controlling biggest piece of equity. But I'm digressing. But what I'm trying to say is just sometimes you're getting caught up for too long in some kind of confirmation bias, where you
Yeah.
think this is the right way to do it. There is always other perspective, right?
Yeah, no, absolutely. No, very valid point there. And so again, back to industrial. I know
Yeah,
that you're still actively involved in today. For the most part, I know you're based in the Chicagoland area, but
yeah,
most of your investments are outside of the Chicagoland area, and some secondary and tertiary markets. I think you said Midwest, so like Ohio, Wisconsin. You named a
yeah.
few. I think you named a few
Tennessee,
others. So
Florida. We still have
okay.
Tennessee and Florida.
Okay.
Yeah.
Got it. So what does the typical industrial deal look like for you today?
Hmm. Okay. Well, typical industrial deal that actually we bought last one only a year and a half ago, and we transition right now to malls because we can't find a traditional industrial deal that fits our criteria. But let's say I still name it as my box, right? So the box I would buy, it's at least 100,000 square feet, ideally 250,000 square feet. Preferably, it will be a big box in a ratio of 3 to 1 in terms of site and lot. So we will like to have ample parking. Um, and we try to buy something that is that we can double the value. So for example, we'd buy something at 20, 30, $40 a foot. We invest between $10 to $20 a foot. We cut it up that box in a small base because that's where we're getting our premium on the rent. So we cut it up between 3, 5, 10,000 square feet. I think median size base about 5,000 square feet. And we split utilities, submeter it, typically new asphalt, most of the time new roof, new HVAC, new mechanicals, and we release it. And typically we double the value. So let's say something is 100,000 square feet, $30 will be $3 million. You put 220 into. So we call it, and you put another 2 million, and it's worth 10 when you're done. It takes about probably 2 years to get it done.
Yeah.
So that's how our typical buy box was. Now, I haven't been able to buy anything for almost, it's gonna be probably 2 years when I bought the last box like that. I bought few small bays in Fort Myers and in Florida market. I did bought smaller one, 30,000 square feet in Tinley Park in Illinois, but we sold that one quickly. So right now we transition buying in malls because those are, I mean, when I'm talking right now to myself, it seems like I'm buying something that is radioactive and eventually becomes not radioactive, you know. So yeah,
That's
so
funny.
when I was buying those vacant industrial boxes, we started buying them vacant, and then eventually they just went in value so much that we just cannot
Yeah.
increase the value that much. And same thing actually happened with self storage. I bought last self storage probably a year ago, and just I think the pricing went so much compared to what we used to buy. We used to buy 30, $40 a foot, put 10, 20 into it, and you increase the value almost double over 2, 3 years, right?
Hmm.
Somehow it doesn't happen right now. So we have right now the same notion going into the malls because no one wants to fund them. It's radioactive. They're not gonna come back. And I've heard the story. I've heard the story for so many times, So I know it's gonna work out.
Well, let's talk about that. Let's talk
Yeah.
about the malls and what speaking to the the radioactive nature and
Yeah.
like the indoor malls are dead. And so talk to me about what your how does your vision differ from that of maybe what the traditional mall looked like when it was built 30, 40, 50 years ago? Are you putting your own spin on it, or is it just,
Yeah.
hey, I do believe that malls are going to come back in the traditional nature, it's just going to take time? But just give us I know you got a project working right now, so maybe
Yeah.
use that one as the case study. And what was it when you found it? Maybe the market it's in, why you're excited about the market, general demographics, and also again where the real value add play is. And I know that you're already
Yeah.
working through it right now, like you've already started executing on that business
Yeah.
plan.
Yeah. Well, I think if I will try to explain how I think it really this approach comes from rehabbing so many houses, right? And when I look at the house, it's a box, and how we can increase the value in the box. That not necessarily we want to change the use when we're doing the houses, but right, we want to increase the square footage and whether increasing additional bathrooms or raising the roof or adding an addition. Because we're doing a lot of value add deals, heavy value add. Same thing what we did with industrial, right? So a lot of times we would just look at the box, and it's mainly adaptive reuse. So we're not necessarily just putting light renovation into it and trying to get the same customer. We completely would change the use of that facility. So let's say if it was a big 100,000 square feet box, we would make it very functional in terms of small business, and we would cut bunch of drive-in doors around the perimeter. would make a hallway in between, like 20 feet hallway in that box. We need to completely update the sprinkler system, mechanical separate. So we actually bring in completely different tenant, and it becomes not necessarily industrial, even though it stays maybe in a same zoning. But we bring automotive users. We bring a lot of contractors. So that's how we do deal with industrial. So we'll look at the malls, right? I look where is that mall located. So first of all, most of the malls are between 50 and 100 acres. I would say that those regional malls that we're buying, they in their glory, they were valued between 50 and 100 million dollars. That's where they were trading in the 90s and early 2000s. Per regional mall. Most of them, they are on the highway and heavy intersection. And if you think fundamentally, try right now to buy in even a tertiary or secondary market, right? With a decent demographics, I'm talking, $50,000-$60,000 and up. Maybe in terms of density, I still like to be about 50,000 within 5 miles. Sometimes I can go lower, but I like at least to stay there. If you want to buy, 50 or 100 acres, just first of all, there's nothing you can't find anywhere in America, this type of piece of property anymore. So, if you're falling back to the principles, I can scrape the lots and just use this land, worst comes to worst, because you can find them right now at the same prices I used to buy those industrial properties at $9 a foot, not counting how much I can buy the land for. So when you look at the mall, first is what would be the highest and best use. And I'm like, okay, if it's not going to be a mall, right? So a lot of times, if logistically has enough traffic, I know that what we call business incubator users, which is a fancy way to say e-commerce and industrial users, because we don't offend cities. If we can prove to the city that you need those spaces and we can activate the space this way, that's going to be the first go right away. And then, we look at the front of the mall. Most of the time, municipalities will not allow you to get away from retail zoning. So then, okay, so who is going to come here instead of Macy's and Sears and Bed Baths and Beyond and Buckles and all those? If they're gone from there, most of them are not going to come back. Then we try to bring entertainment users and food and entertainment and some boutique retail. But that's typically I try to shrink it to most effective square footage possible. Let's say 500,000 square feet. I probably want to leave no more than 100,000 square feet for that food and entertainment. And maybe in the middle to have a sports facility, depending how many sports facilities that region has. Pickleball courts, basketball courts, that type of thing. And then outskirts of the mall who are facing that traffic area. If I can do what I did with industrial and bring HVAC, general contractor, those bigger contractor base, and if the city will allow it, for the most part, I can achieve and put the lights back to this facility within 2 years. And of course, the CapEx budget, it's probably going to be 2-3 times of the purchase price. But that's what it takes. So to just come back to a question, it's not going to be your typical mall. It's going to be your new, we call it the center. We call it, for example, Piqua Center. We're going to call it the Ontario Center. We have another one. But it comes down to really coming back to the numbers. E-commerce right now, it's over 30% of all the commerce, right? And it's going to be 50% by 2030. So it's not realistic that those Macy's and Sears will come back in one shape or form. At the same time, there's so many e-commerce users in our malls. We have, if I would put a number, probably 20-30% of e-commerce users. So most of them, they don't have retail presence, but they're still doing their operation and warehousing, not through dropshipping Amazon, but doing in-house, and they're shipping from those warehouses. Some of them they have some small retail presence in the front, which maybe have like a couple of customers a week, right? But most of them dealing online. So just kind of looking at the location and just really doing adaptive reuse. And it's case by case. Every single mall is very, very different. And man, the biggest challenge I think is municipalities, convincing municipalities to draw a line. And if it was 10 years vacant, I think it's time to allow to someone to make that some creative project out of it. But and really 100% we went in, everyone is happy.
Yep. So the two mall projects that you're currently working on, were they 100% vacant when you took them over? Or did they have some, kind of legacy
They
tenants at
have
them?
some legacy, so Piqua was 70% vacant. Right now, another one working is on the Ontario, the Richland, Mansfield Mall in Ohio, and that's one is about 15%, approximately 50% vacant. So they still have some income. In the way you underwrite it, they're probably in place, between 5 and 10 caps. But that rental is dwindling, dwindling
Yeah.
fast and quickly. So you have some income, but you have to operate quickly and put those users back in.
Yeah, very interesting. And so, just curious, like when you go into one of these markets again, using either one of the current projects that you have in the works, you're determining highest and best use for a such a large project in a smaller, generally speaking, a smaller market, right? If we're talking like
Hmm.
a population of like 50, 100,000 in a 5 mile radius, and what's the average size of these two malls? Like, are they
About
300,000 square feet?
half a million square feet, between
Okay.
400,000, half a million square feet. Yeah.
Okay, so a lot of space to figure out what to do with, right? And so determining like is there a science to trying to determine what the highest and best use is? Is it part gut, part, what does the municipality want to see? Do you engage the local residents to find out, survey them what they want? Like what does that process look like?
Yeah, so the process typically works. Yeah, so first, of course, I want to hit those check marks. At least 50,000 people population within 5 miles, and
Yeah.
then I look what's going on within 20, 30 miles. Most of those malls, they are actually the regional malls, so they're hitting bigger metro areas. So let's say one of the when in Piqua that we have, they're hitting Dayton market, which is I think it's 250,000, which is in within half an hour. And they covering other metro areas, but at least I want to see it if at least 50,000 within 5 miles.
Hmm.
Then of course, second thing I'm looking, what's the vacancy in the region within 20 miles, what's the vacancy within for industrial warehousing users, because that's where you're falling back. Because I'm counting, I'm gonna be able to fill in at least half of the space with those warehousing e-commerce users, or I'm look at the vacancy over there. I want to see 3-4% vacancy, no more than that. uh and what's the pricing. We try to be always leader in the pricing and since we're buying at such a low basis, we're able to deliver those spaces at
Hmm.
$3-4 a foot when everything is maybe like 5-6 around us on industrial use. And so that's first test. And then, of course, you testing the municipality. Are they willing to play ball? Are they stuck up with just retail, or they are going to be a little flexible to allow to bring pickleball courts, basketball courts, and e-commerce and warehousing users. Many of those municipalities have outdated zoning codes. So it's
Yeah.
really black and white. There is no, and for example, let's say, how would you qualify right now American Freight mattress? Is it warehousing or is it retail, right? Or for example, I mean, we have food and wine distributor. I mean, they mostly ship online right now, but are they retail or are they warehousing? Because even right now, take at the Walmarts, right? They're shrinking our footprint in the front and expanding in the back because they have so much e-commerce going on. So
Yeah.
so a lot of times municipalities stuck up either black and white. It is still kind of a quasi use e-commerce, which is not really warehousing and it's not really retail. So that's a big hurdle to overcome with the municipalities, how they perceive that. And also another entertainment users, if they want pickleball courts, they want a basketball court, you want trampoline parks is not difficult, but some of them municipalities don't want pickleball courts. I don't know why, but they don't, even though you can probably put pickleball court anywhere right now in the
Right.
country, right? No, I mean, you
That's
can,
right.
there is shortage everywhere. As long as you have 18 foot clear, you can put anywhere. And so, but at the same point, you have to buy low enough to install pickleball court. Depends,
Yeah.
if it's an hour, $25 or $50. But you can install anywhere the pickleball court.
And you guys, I think I saw that one of the adaptive readaptive uses that you guys put into one of the big boxes. I don't know what used to be there. It's some type of indoor entertainment. I don't know if it's a jump house or what
Yep.
it. Maybe speak to that a
Yeah,
little bit.
that
And
was okay.
what was that space prior
Yeah,
and
that was no Cinema Hall, Cinemark, I think. Yeah, and it was 6 or 8 halls right now, I don't recall, but it was 25,000 square feet. So we brought Hero Day, which is trampoline park, family entertainment trampoline park. It's a fourth location for that operator. And yeah, it cost us about $700,000 in TI to get it done. I mean, we had to put, I think, 18. So if you understand, if you imagine a cinema, I mean, the floors that have a
oh, they're all
slope about
sloped. Oh
35. Yeah.
yeah.
So we had to cut a 14 by 14 door into that box, and we had to bring 1,800 trucks of stone, and I think 800 tons of concrete to level the floor. But our bases were $6 a foot to buy, and call it 700,000 on 25,000. So that's another probably $30 or whatever it comes down to. I'm just gonna do math quickly. Divided by 25. Yeah, about $30 to get it done. So call basis 36. It still works. It still works because bases are so low
Hmm.
on buying. And we put him in there, and we know it's going to be successful because he has other locations in that region which are very successful. He's bringing 200,000 people a year right now. He's opening the doors, I think, in a week or so. Yeah.
Okay. No, that's fantastic. That's exciting. So
Yeah.
I would say, based on what you've mentioned, if the municipality is black and white and they won't allow you to get, a percentage, I think you said to go close to 50% of it, being for some type of e-commerce use or, flex space use, then you kind of move on. Is that like the deal
Yeah,
breaker?
that
If
that's probably that's probably would be a very correct
okay.
assessment. Yeah.
Okay. Good deal.
Yeah, correct assessment. If they're really trying to put handcuffs that no, it has to be retail, traditional retail, it is just doesn't matter how deep you're gonna buy. You're just going uphill
Yeah.
battle. Uphill
It's
battle.
crazy. Like that's mind-boggling to me, given that a lot of these malls they've been dying for quite some time. This isn't like, oh, COVID happened, all of a sudden the mall shut down, right? Like
Yeah.
they'd been seeing a decline in occupancy for like the last 20 years, right? I mean,
Hmm.
it's just been like a slow death. And then COVID was, for a lot of malls was like the nail in the coffin, right? But like just seeing, the local leaders, like they've seen it going, they've seen it happening, right? They've seen the trend going in a declining manner, that they wouldn't be more proactive about new ideas and new opportunities to fill that space. I mean, are they stuck in the illusion that this is once again going to be the same thriving mall that it was, 30 years ago? Are they stuck in that
So
mindset,
I think
or
there's two things. So yeah, so one of the things that we do before we buy, right? I myself typically I go in the community, I start being active in that community. Yeah, I go on the radio shows, I go on social media and all kind of boards, and we start polling community what they need, what they're looking
Mhm.
to see, and you'll be surprised. Community, not most of them, but big percentage of the residents or citizens of that community. Typically, they still somehow see, can you bring Macy's or Marshalls or Sears or whatnot, and they maybe they just don't know exactly how it works, and somehow people
Yeah.
people miss those moments, and I think maybe
Yeah.
somehow it's gonna come back, and I think elected officials, they have to act on that on that notion, right? When you get like 1,000 comments, out of those 1,000 comments, maybe only 200 understand the reality, real reality. Okay, this is not coming back. This is going to be different. This is going to be trampoline park. This is going to be commerce. This is going to be, some local restaurant. And 800 maybe have still that notion that they want TJ Maxx. They want TJ Maxx, but TJ Maxx is not going to come in that. I don't know how to explain the community exactly. So officials, they kind of have to, I think they have to try to come up with a solution how to do it. And so that's number one thing. Number two thing that what has been happening with the malls, many of them they got bought out during decline, and they were chopped off and sold, parceled out. So, for example, they take a big, many groups, they bought those malls and they parcel out. McDonald's goes there, hotels goes to another way. So they buy one piece for $10 million. The middle of the mall, which is most unfunctional, they keep it in declining. And and the front pieces, McDonald's, Chick-fil-A, Taco Bell, and hotel they sell for $2-3 million. So that's how they make money. And technically, nothing. There was no benefit to the community. Someone made
Right.
money, but so there's a bad stigma to those transactions. So when we come in, they think, oh, it's gonna be another group from Chicago, Minneapolis. They're gonna do some trick. They will do some, creative financing deal here, and community is not going to get nothing from this. So it takes quite a lot of effort to overcome that initial stigma when we try buying it.
Yeah. Are most of these malls, the ones that you purchased, are they already in like an REO state, or are they still, owned by an investment group?
The ones we bought, it was from investment group. They had some tax delinquencies. But the ones we look on having in the radar right now, they most of them have some sort of, tax delinquency issue, or, delinquent loans, or code violations, some of them condemned. So there is a lot of, problems with them. Yeah. So most of them, I would say,
Okay,
the ones
good deal.
especially vacant.
Yeah, yeah. I know outside of the mall projects, you've got a number of other things that you've maybe you're not focusing on solely today. It sounds like malls, like that's where you guys are putting a lot of your emphasis, correct?
Yes.
Like at least in the near future, right? Until you don't see an opportunity anymore.
Yeah.
But I know that also we share the same.
Maybe that's gonna be offices, but it's still too
Yeah,
radioactive.
yeah. Again, I don't think the statement I'm about to make is fully accurate, but I do think there's some truth to it in that, obviously there was a big push by a number of employers, large, corporations to get employees back in the office. And it just, some were slightly successful, others not very successful at all. And many of them just failed completely with getting anyone back in the office. And so I'm of the opinion, and at least for the foreseeable future, like I feel like we're like it's close to as good as it's going to get in most of the major markets, as far as the current companies that are there now, getting their workforce, fully back in, or at least maybe close to what it was pre-COVID. Maybe I'm wrong, but I feel like we've had enough time now after
Hmm.
COVID to, to see how this plays out. And again, I'm by no means an expert, but I personally still think they're radioactive to a certain degree. Not all of them, but a lot. A lot of especially the ones that are millions of square feet. Like Chicago, for example. Chicago's got a major issue, right? Like
A
they've got
major issue,
they're
major issue,
yeah,
yes.
yeah. And it's not just the office, right? Like there's other other variables that get thrown in there as well. And so I don't know when that comes. Again, Chicago's irreplaceable, right? Like no one's ever going to say that city's going to die, right? Like it's just
Yeah.
like New York City went through
Hmm.
it's gone through its roller coaster rides over the last like 40, 50 years, right? And it always seems to come out on top. Like you're not going to take away the desirability of living in New York City. And I feel the same with Chicago. However, it's got challenges and some big ones
Yeah.
that's got to work through. And I think because of that, ultimately it's going to have major impacts on local companies who wanted to keep their headquarters there, and people don't want to live and work there, what have you. But anyway, not to
Hmm.
digress. But so where I was going with that is, I know that you and I both share a love for not just parking. Again, we love parking investments, but also truck parking, which
Yeah.
our Sunrise Capital, our group's not invested in, within our company, but I understand the iOS space really well. Love truck parking facilities, and I know that you actually own a number of truck parking facilities. Even developed a truck parking
Yeah.
facility in the last couple of years, correct?
Yeah, I do have two bus terminals here in Chicago, school bus terminals in Chicago. That's probably my favorite and best investment that I've done. It's I yet to receive one phone call in 5 years from them. It's just it's it's triple net, but it seems like it's almost like a ground lease,
Yeah,
the
that's
the
great.
the way it's written. So it is a small facility, like 15,000 square feet facility on 5 acres, and there is another school bus terminal, also 15,000 square feet in a maintenance facility on a 3 acres. But yeah, it's just a great investment in terms of how little management it needs, and how much, probably use the Warren Buffett term, moat it has in terms of, to replace that operation
Yeah,
for the school district in established neighborhood. It's just, it's economically, it's probably not feasible, because there is nothing exists like that within half an hour away. So it's almost like, holding a patent on some medicine, having that site, because there's really, there's practically, they have nowhere to move it, or if they move it, they will just add another half an hour commute to their time, so they can't do it.
right. Was that
um
privately owned when you purchased it, or was it owned by
yeah,
the
that was private. Yeah, it was
school?
private loan when we purchased it. Yeah.
Okay, okay,
Yeah.
very interesting. And then
Yeah.
aside from that, but the bus terminals, you developed, I think, a traditional truck parking facility,
Yeah.
right, for like
So yeah,
semi trucks
yeah.
and big rigs.
Yeah, so I developed, and it's a fancy way of we calling develop. We bought pretty much an entire block in Milwaukee, two buildings, total 165,000 square feet and 15 acres. It was mismanaged, misused, but at some point it was gravel, and it had some asphalt, so we did not have to go to major engineering in terms of, retention ponds and stuff like that.
Hmm.
So we just layered another new layer of asphalt, gated the parking lots, put cameras, and I used I just come up with the system myself. We managed the prior to that self-storage facilities, so I put two access control gates using ESS, I think, storage, and we controlled access this way, and use the self storage facility software, and it got full within 6 months. We started from $100 in 18 months. We raised to $205 in 18 months. So it was like three jumps of pricing, and we still can't find the bottom. I mean, the ceiling,
Oh,
how high
that's
it can
great.
go. Yeah.
Yeah, that's
And development
what
was
is it? What is it today a month? How much?
$22,000 a month. And now my capex was about $5 a foot on 5 acres. So call it, it was so 5 acres was like less than $2 million, I think. Yeah, I think less than two
And
million.
what are you getting per truck site, per
Two
parking
two
spot?
oh five.
205. Okay.
205,
All right.
yeah. Yeah. Times
Yeah.
five. No, so my capex was about a little over $1 million.
Hmm.
A little over $1 million,
That's
and right
exciting.
now, yeah, over $20,000 a month gross. Yeah.
Again, if you could scale that, right, and have 30 of those across the country, right?
Exactly. Well, the challenges with major metro areas, they do not allow outside
Yeah.
storage. It's pretty much,
Yeah.
it's really hard to find. And we were just got lucky. We bought it. It was already, we had one use with an existing tenant. So kind of slide it in with that one.
Yeah, no, no,
Yeah.
fantastic. So, just to kind of wrap this up, Saul, I very much would define you as a contrarian investor, right? I mean,
Yeah.
I think you'd probably define yourself as that as well, right? I mean, just going the opposite direction of the herd, and finding opportunity where others might not be looking today. Just
That's
like
it.
industrial malls, what have you. And so, any final words of thought or wisdom for those that are tuning in here, as relates to just seeking opportunity in today's world.
Hmm. I guess my my approach was, from 20 years ago, I want to buy something that I can double the value. Meaning, if I buy something for $100 and I put another 50, I want it to be worth $300. with my effort, obviously, with my effort, and maybe within 2 years. So I think that was my approach: buying everything, anything.
Mm-hmm.
And I don't underwrite rental increases typically in our value add deals. And it worked out well. I don't have any deal that went wrong, or I think it just, and I went through 2008 with this, using the same approach of flipping houses
Mm-hmm.
in 2008. I still have one house that didn't sell in Lamont where I live. I was carrying it for a long time, but I was able to weather the major storms, I think, just using this approach. I
Yeah.
want to buy something and double the value in 2 years.
I
You
thought I
know,
thought I thought you meant that you still own that same house today because you couldn't sell it, or
yeah. Well, I still own it just because I have a really nice
Oh, okay.
tenant over
Oh,
there. Yeah,
okay.
but
I got
meaning
you.
I
I got
had
you.
to. It was really, I bought it like 2009, right before the crash, and
Yeah.
I had to hold it for a long time because it was upside down. But that's the only thing that I really was not was kind of was hurting, because I didn't buy it right. But if I use the approach, that I want to double, and so you have to buy something that really no one wants it. You can't buy right now self storage. You can't buy right now industrial property that you can double in value, unless you go a different approach where you can
Yeah.
probably want to underwrite rental increases to the towards inflation. But then I don't know, it just becomes that, probably not real estate, but money raising game. At that.
Sure. Sure. No, that's
Yeah.
fantastic. And so I really appreciate your insights, my friend. And it's been great having you on here and just catching up with you. I've been looking forward to catching up with you for quite some time, and glad we're able to make this
Thank
happen.
you.
So for those that want to learn a little bit more about what you've got going on, is there a place that they can track you down to, learn about your projects, different
Yeah.
investments that you have going?
Yeah, ideally you want to track me on Substack, and just go on Substack and search for Soul Z, and you'll see my link. Soul Z on the Substack.
Okay. Guys, I'll put that in show notes as well. And my friend, again, always a pleasure chatting with you, and I appreciate you coming on here today.
Thank you very much. Thank you. Thank you. Thank you.
All right, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.